Proudly brought to you by Investment Solutions with confidence.
In July 2013, the FOMC revealed the US Federal Reserve remains on track with its quantitative easing program, with a monthly spend of $85 billion comprising $40 billion in residential mortgage-backed securities and $45 billion in treasuries. Interest rates will, for the moment, remain at record lows. However, it appears more than likely that Mr. Ben Bernanke will indeed begin tapering off the asset purchases within the coming months. The announcement sent stocks up and then down, but remained in a relatively tight range. The yield on 10-year treasuries trended lower to 2.684%. The gold price took a slight knock, and major banks like JP Morgan Chase, Bank of America, and Citigroup edged up. It's evident that investors are a tad cautious, just until there's more clarity on the Fed's quantitative easing exit strategy. Of course, the big question that's on everyone's lips is what happens when QE comes to an end. Derek Masibe, MD of Investment Solutions, says it'll hurt, but remains positive that in the long term, the outlook is good.
I think the markets will be in a tailspin for a while. Volatility will go through the roof. And I think at that point in time, someone will have to dish out their hard medicine, which is required to get the economies and all of that into a much more solid footing. So the austerity measures that we're all running away from, that's when the D-Day will come, when they will have to be implemented. And during that time, we all know that we'll go into a state of something akin to a depression. But obviously, when we emerge out of that, we'll be in a much better shape than what we are now.
Peter Schiff says quantitative easing has simply delayed the inevitable, and the future looks very bleak for the US economy.
We have serious problems because of what the Fed has been doing. For years and years, the Fed has been artificially manipulating the economy. They've kept interest rates too low. As a result, we've developed a bubble economy. We have too much resources in the service sector, in housing, in financial services. We have too much capital and labor in healthcare and education, but we don't manufacture enough, we don't produce enough. So we have these enormous unsustainable trade deficits. So we're going into debt to the rest of the world. The only reason we can afford it is because rates are low. We have this enormous government right now that's running these huge deficits because rates are low. All we're doing is postponing the inevitable, but the longer we postpone it, the worse it's going to be. But unfortunately, our leaders don't care about the long-term health of the economy. They're looking at what's right politically for themselves. They're doing what's expedient, not what's economically good. And so we postpone that pain, but at the expense of far more excruciating pain down the line. My fear is that day of reckoning is not too far away.
The US stock market since March 2009 has risen approximately 250% because of this dramatic, some would say beautiful, monetary policy that has been not just initiated in the United States of America, but has been perpetuated by the US and also is being copied elsewhere. Is it going to end in disaster? Can you predict what might happen when QE eventually comes to an end and interest rates eventually start to rise?
I'm not going to try to predict how this will end. What I do know is that this is a new territory. This is uncharted for economic systems. We have never seen, to my knowledge, this level of globally coordinated monetary easing. And therefore, when it ends or when it starts tapering away, I think the impacts, there are no models that can predict what's actually going to happen. But we do know that at a certain point, things will return back to normal. That interest rates are going to normalize over the medium term. What that means on the real economy, we'll all soon find out. But what I really want us to realize is that these are not economic questions that we're dealing with anymore. They're not even political and social questions. We've gotten to a point where there are moral and psychological questions. These are the problems of the world today. The problems in this country are not around us. This is the most sophisticated, wealthiest country in the history of humankind. The problems are internal. They are in what do we prioritize as a country, and how is it that we want to live our lives? And I think quantitative easing and the fiscal stimulus and all of this are all part and parcel of a greater malaise that is affecting Americans.
It's unclear whether or not quantitative easing has worked. Some months' data out of the US, be it unemployment figures or ISM numbers, suggests it is working. And then a few months later, the data shows the opposite. Stephen D. King, chief economist at HSBC and author of the book When the Money Runs Out, says these false starts carry echoes of Japan during the 1990s.
Sometimes the Japanese authorities would, if you like, proactively tighten monetary or fiscal policy in anticipation of the big recovery they hoped to then see. The big recovery never ever occurred, and of course then the policymakers were blamed for having tightened policy prematurely. So from that point of view, the Federal Reserve clearly is worried about doing something too aggressive too soon, because it might just sort of upset the apple cart to a considerable degree. But having said that, there's also, I think, a gradual sort of mutation of the debate, because when QE was first adopted, the general view was it won't do any harm at all and might do some good. Whereas now it's clear that it may have done some good, but there are now more debates about whether it's also perhaps creating some damage to economies.
SA Reserve Bank Governor Gill says the steps taken by the Fed were based on the data and information they had at the time.
I would say that you need to look at it and say, what were your options? I'm a supporter of measures taken to try to address something that could have been far worse. And don't forget that behind all these numbers stand ordinary people. At an unemployment rate, whether you are at the US, which is talking about 7 or 8%, around those numbers, or you're talking about a Greece or a Spain or South Africa, which are above 25%. Spain's unemployment moved from about 8% to now over 26%. Youth unemployment well in the mid 50%. It's not confined to the periphery. You've got significant, over 12% unemployment across the Eurozone. It varies per country. France, all of the countries are affected. Italy are all affected, especially by youth unemployment. So the challenge that we have is to look at what we don't know the counterfactual. We don't know what else there would have been.
Many believe the current state of the economy in the US will take generations to correct.
The US has probably one of the more trickiest financial situations in that over a number of years, its expenditure has exceeded what it is getting in terms of the taxes. And when you look at the amount of debt as a proportion of GDP, it's increased to where it's over 90%. And that is the amount of debt that you can measure. But when you add the other commitments that they've made, which they've not incurred, Medicare, Social Security, etc., that debt becomes almost twice what the GDP of the US is. So the US's major problem is not so much the existing deficit, it's just the commitments that it has made to its citizens for future years. It's more of a lesson to say that for us who are small, insignificant countries in the world economy, we need to understand that we do not have the luxury and the bargaining power that bigger economies have. Things get imposed on us. So if we do not impose a discipline on ourselves on spending and living within our means, it doesn't take long to end up with what's happening in Cyprus, where you wake up and they tell you, you want 10 billion euros, here's 10 billion euros, but by the way, all your depositors in the banks are going to lose 10% of their money, not just South Africa.
There will be consequences, including for countries like ourselves, as we've seen in many emerging markets, just at the reaction of the markets to his talk of tapering.
Yes, our bond yields spiking dramatically. What was the effect of QE on South Africa? Did you see the flows coming in to buy our bonds, buy our equities? And what was your reaction to that?
Well, and again, it affected many emerging markets. So if we looked at the impact of zero interest rates, and then QE. Obviously, take pension funds, for example. Pension funds have a fixed obligation. They've got to meet their payments. If their earnings are at the level of what you've got in the United States, when you're at zero bound or below, they obviously look for other sources of funds or earnings, so that you saw big flows into most emerging markets. In the 5 years before 2007, the average bond, non-resident holding of bond inflows, the bond inflows were around 5 billion a year. They went up to over 60 billion a year on average for the following 3-4 years. This year so far we're still positive in terms of bond inflows, but again, some of the things have changed with the tapering question, as well as some of South Africa's specific issues. But you saw a shift between equities and bonds. Before, we had big flows in equities and small in bonds. Over that period, very significant inflows in bonds. So yes, and what does that do? To depreciate your currency. So we were somewhat overvalued. That affects your manufacturing sector, it affects your exports. Now, what has happened with the talk of tapering is that you've seen outflows from all of us. Quite savage in some instances, and then you've got a depreciating currency. So the challenge that you've got with a depreciating currency is that we're an oil importing country, unlike others. So therefore the price of oil goes up. It has an impact on transport costs, fuel costs, so it hits ordinary people. Equally with the depreciating currency that we've got is that your exchange rate is a factor in terms of inflation. So it depends how long we're at a weaker level, how weak that becomes, and what the pass-through is.
And while the world's economies anticipate the return of normalization, the question about the accessibility of money still hangs in the air. Does money grow on trees?
You know, there are always stocks that are going up and down. It's possible to make mistakes. A lot of people who thought interest rates were going even lower than they were have lost a lot of money very quickly in this rise in interest rates over the last month. This is still a very risky business. It's generally true that the media focuses on the winners, but there are a lot of losers along the way. It's a much riskier business than most people think.
If you're sitting in Portugal, in Greece and Cyprus and those places, you really understand that money doesn't grow on trees. But in the US, it's a matter of, it is still years away before you're forced to actually deal with the reality of the fact that there's not much money going around to be able to meet the obligation that the government has actually made to you.
Well, our money's actually printed in cotton, I believe. So in that sense, no. Central banks have a lot of scope to kind of affect financial outcomes. That's not the same thing in my mind as printing money and whatnot, but they can do a lot.
It's easier than money growing on trees. The Fed literally says, poof, I'm putting this money into your account. It didn't exist before, but here it is now. I'm buying these bonds from you, Mr. Primary Dealer, and I'm paying for it by actually putting $10 billion into your trading account here at the Federal Reserve. What you do with it from here is up to you.